Hello, this is Jordan, and this video update is being recorded on the late evening of Monday, November 28th, 2017. Thank you so much for tuning in. In this video, I'm going to talk about Donald Trump's election victory, how that has affected gold, how it's affecting gold at the moment, and what the effect may be in the near or distant future. Now, starting off, we're going to focus on real yields and real interest rates because that's a fundamental driver for gold. If you've seen my videos before, you know I talk about this quite often. You might be sick of it. I'm sorry about that, but it's just so important because what we see here, if you look at the far right side of the chart, you can see that since the middle of 2015, the real Fed funds rate and the real 5-year yield have declined. They've gone from slightly positive to negative, and that's what gave us the great run we had in gold in the earlier part of 2016. Now, the real Fed funds rate right now, inflation is the CPI is at 1.65% or so. The Fed funds rate is about 40 basis points. It will be up to 50 basis points when the Fed officially hikes in December. So even if you round that up to 50, that is still minus 1% and change. I think it's minus 1.2% on this chart, but after the Fed hikes, it'll be about minus 1.1%. Now, the real 5-year yield, however, I'll show you in the next chart, the move that we've seen in yields has been very, very strong. And so, from that perspective, the real 5-year yield has gone positive. Now, that's not updated yet in this chart because we don't have the CPI reading for November. So that recent rise since the election is not factored in here in that data point yet, which is still at minus 0.38, I believe. But if you look at where the 5-year yield has gone, it's I think it's gone up to about 1.8%. So that means the real 5-year yield has gone from at one point in the summer minus 0.5% or even a little bit worse than that to now positive. So that's obviously negative for gold. Now, here's the chart which shows the yields on the 2-year, 5-year, and 10-year. And we're talking about nominal yields here, so not real yields. And we highlight the box, and the box there shows the time when we had the huge move in precious metals, and that's because yields declined considerably. Fed hikes were off the table, yet at the same time, inflation was quietly rising. So that was obviously very bullish for precious metals. But since that point, yields they trended higher, and they really surged in the wake of Trump's election victory. And specifically, we're talking about the 5-year. Today, that peaked at 1.8%. I mean, that was in the summer at its low. That was 0.9%. So as I said, the real 5-year yield in the summer at that point was, let's just say, around minus 0.5%. Now it's plus maybe 0.1%. So not a huge move in the big picture, but still, I mean, that's a very significant move. Went from negative to positive, had a big rise. It's negative for precious metals. And the other thing here is you can see there's a potential major breakout in the 5-year yield. I'm not saying that's going to happen right now, but look, we can see that 1.8% has been significant resistance over the past 3+ years. So that's something to keep in mind. Right now, the bond market is really, really oversold. Gold is also oversold. So I think we're going to get a snapback rally in both the bond market and the gold market. And so yields, of course, are really overbought. So you could see them consolidate for a little while. But I do think that the 5-year yield in the next couple of months could be threatening a big breakout here. And that would be a catalyst for even more dollar strength and even more weakness in precious metals. Now, not to get too far off topic, I don't think that yields, we'll talk about this at the end of this video, but I'm unsure if we're going to see some huge, spectacular rise in yields next year. Based on history, I don't see that happening. Trump's inflationary policies, they're going to take at least a year to probably take effect. So it seems that if we get another move higher in yields, I would want to fade that. And that after that potential breakout here in the 5 year. After another big move higher, that could potentially, uh, when that starts to reverse, that could be the catalyst for gold to put in the next important low. But anyway, to get to the next chart, this is a new one. I just uploaded this data. So we have the weekly chart of gold there, the weekly line chart, and then at the bottom we have which is the real yield, which is on the 5 year Treasury inflation protected security. And so that data is I got from the U.S. government website and just uploaded that here. And I've seen, people have this, they show this chart on Bloomberg and other areas, but this is just one way of looking at real um, real interest rates, I guess, on the very short term because you can get daily data there. And to go back to the beginning, my master fundamental chart, as I call it, that I favor that for more long-term trends. But looking at this here, this is kind of as I said, more of a daily look, more of a short-term look. And if you look at what's interesting is, real yields were actually in the mid 2000s when gold and gold stocks performed really well. Um, Real yields were actually positive. You can see that based on this data, and also they were positive at times if you go back and look at the chart at the beginning of the video. But inflation expectations were rising, and perhaps that's why gold was rising, even though real interest rates were not always supportive at that time. But anyway, we can see here, I highlighted, notice how we had the huge decline, or the huge move higher after during the financial crisis. Then after, we saw the huge decline based on this metric from 4% down to almost minus 2% all the way in 2012. But gold peaked before that point. But that bottom in 2012 and this metric coincides really well with that secondary top at 1800. And recently, at the end of last year, the real yield based on this metric went from about 0.5% down to minus 0.5% in the summer, but now that has gone up, and that is now up to 0.11%. So this, based on this data is actually really close to the real 5 year yield. Um, so that's interesting, but the pop in the real yield, which has gone from about minus 0.5% to 0.11% today, that's taken this to about an 8 or 9 month high. And that explains why gold is suddenly so weak. That pop and then little move. The pop is the election. Then we have a little move higher in the last week or two. But that's what's fundamentally negative for precious metals right now is the market believes that inflation is going to rise, and that based on Trump's policies, that's going to well, hold on, I got that backwards. The market believes that based on Trump's policies, inflation is going to rise, and we're going to see a more hawkish Fed. So the market is focused on that, and is not yet focused on the fact that if we do see higher inflation, the Fed will have to stay behind the curve because of all the debt that's been accumulated at 0% interest rates. And it's just, this is what's going to cause gold to have a massive bull market in the next few years. We need inflation to get out of the debt bubble, and we need inflation to devalue our debt burden. And if inflation does pick up, you're just not going to see the Fed hike fast enough, and at some point they'll perhaps have to do QE, like we see Japan doing. Keeping their rates really low, keeping their yields really low. So that's something that could happen in the U.S. in the next couple of years. I'm not saying it's imminent, but perhaps in the next couple of years. But to rewind to where we are right now, inflation expectations have gone up a lot, and that's also created expectations of higher interest rates. And so, in the immediate sense, that is negative for gold, and that's what's happening right now. Now, if you look at the top, I'll do a little technical comment, but gold looks like it's kind of in the middle of some really long-term bottoming formation. If you can draw a neckline there in the mid to upper 1300. So it'll be interesting to see in the next 3-6 months if gold comes in and makes a double bottom or makes a slightly lower low. But gold is after it makes this next move down, in my opinion, I think it's primed for a snapback to that neckline, and it'll consolidate after that, and eventually there's a potential move up to 1600 if you look at the red line down to the bottom. So that's just something to keep in mind for the next year. But let's get to my final slide here and just some things I'm thinking about, some questions I'm asking. I mean, this move we've had in markets, I mean, you can call it the Trump move. Is it really going to sustain itself next year? If it does, that's bad for gold because we've already seen so far it's been negative for gold. It would be good for gold if inflation really accelerates next year. That's the only way it'd be good for gold, but I'm not sure that's going to happen because Trump's policies are probably they're not going to take effect probably until 2018. So if inflation is going to rise next year, it will, have to manifest itself in some other way. So what gold really needs, it needs lower yields or higher inflation. We talked about the higher inflation. I think that's more likely in 2018 than 2017, but look, that's just a guess right now. It's a comment subject to change in the months ahead. So I'm really more focused on lower yields. I mean, we need, if this Trump move in the markets fails at some point and reverses, it kind of goes the other way, the reflexivity that Soros talks about. If that happens, you would get lower yields, and that would be bullish for precious metals. And gold also needs it needs stock market weakness, it needs economic weakness, and of course, if that happens, you would see lower yields. Is the beginning of all that some really, really strong move in the dollar that causes people to pile in the bond market and and causes people to sell stocks a little bit? I mean, it's possible, but something to keep in mind. But as I already said, I mean, Trump's policies are not going to take effect until 2018 at the soonest. So that's kind of where we are now with respect to the big picture for gold. Technically, gold I mean, it's having a bounce, but it looks very, very weak, and I would expect this bounce. I mean, it could last for 2 or 3 weeks, but ultimately, I think gold is probably going to retest its low in the first quarter of next year, and perhaps a little bit after that, it can make another major bottom. That's all in this video. You can follow all of my work at thedailygold.com. You can opt in there for my free newsletter and the free weekly update that I send every Sunday. You can get my most recent thoughts on the sector in that email and some snippets from my premium update, which I published the day before. Thank you again for listening and watching to this video, and I look forward to publishing another video update for you in the next week or two. Thank you.